The venture capital topic is one that obviously is important to me. Pleasure to have Scott Burns of Mairs and Power with us today. Scott has co-invested with me in one of my portfolio companies, so excited to tell you a little bit about that and share some stories about what he's looking to invest in, our thoughts on a variety of topics, including things like valuation. And anybody who knows me knows that that one is a big one. So we're going to cover a variety of things about venture capital investing and what VCs are looking for in an investment. All right, I'm going to try to, that one's way different. I'm going to try to leave some time at the end for questions. So not that I don't want to address those questions, but why don't you let us cover what we're going to try to get to. I'll block out some time, hold your questions, and we'll try to get to some at the end. As I mentioned, Scott Burns is a general partner at Mairs and Power. We knew each other way back when he was running his first company, Gov Delivery. And then he ran a second company, Structura. Prior to that was doing consulting at McKinsey & Company. And so I've known Scott for many, many years. And then I have the privilege of having Mairs and Power in one of my portfolio companies, Akoya Go. In fact, Akoya Go was the very first investment that they made out of their first fund. In addition to the business stuff, Scott is very active in the St. Paul and Minneapolis communities. Welcome to the stage, Scott, and why don't you tell us a little bit about yourself?
Thanks. Can you hear me okay? It's just my angle, I think.
Okay.
All right, I got it. I've never sung in a nightclub or anything. Yeah. So it's really good to be here. It's one of my favorite parts of being from Minnesota and being here for a long time, working to have long-term relationships with people like Rick and being able to follow their story and intersect with it and see all of his great work. So we'll talk more about that because we're going to get a chance to talk about Akoya Go. I'm recently a venture capitalist about a year ago, but I've been an entrepreneur most of my career. Rick mentioned that I came out of college. I was in college on the East Coast. Having grown up in Duluth, I was a ski racer. I was not one of these entrepreneurs who had a lawn care business when I was young. I was very focused on sports and politics to a certain degree because my mom was on the school board and my dad was really into politics up in Duluth. And so, but sports was about 98% of my energy. And I used that to move to Colorado when I was 15 and then to Vermont when I was 16 and spent 6 years in the East Coast. And then I was convinced to move back to Minneapolis, which I told my brother no way. And he's like, have you ever been anywhere besides Welch Village and Afton? And I'm like, maybe I will come check it out. So I was impressed. I came back here to work at McKinsey for a couple years. And it was the dot-com boom. And I was very interested in venture capital at the time. This is way back in the 90s still. But I thought if I'm ever going to be a venture capitalist, I should at least try out being an entrepreneur. And I got a job as the 8th person pre-revenue in a startup that did renter screening for apartments using the web and data models we had built out at Harvard. And this was way before AI and machine learning. And that business went from 0 to $1 million in revenue in about 7 months. So I was like, man, this is easy. That was a very false indicator of my future trajectories. But I did that. I got into business school, left that company, came home just to spend a little bit of time before leaving for business school, got a company started called Gov Delivery. It was actually called Gov Docs at the time. We started out doing labor law poster compliance, and Gov Docs still exists today doing that. So the minimum wage posters and things. Then we launched a software company, which was sort of my idea to help government communicate directly with the public using software rather than have a middleman organizing things. And that company was really, like many companies, it was a struggle to get it going. The dot-com boom. Well, about a day after I gave up my deposit to a great business school, the dot-com boom became a bust. And I seemed like the person with the worst timing in America for about 5 more years after that. But we stuck it out with the business. We raised a lot of angel money. We got a lot of support from this community and from everybody else I could get to support from. And we grew that company, Gov Delivery, which started out doing the snow emergencies for St. Paul and then Minneapolis, all digital communications for government. We grew it to doing digital communications for the entire federal government. We were very dominant in the UK. And ultimately, without raising much venture capital, grew it to between 7 and 10 million. It was 10 million if you combine the two businesses, GovDocs and Gov Delivery. And then we had a private equity firm buy it. I stayed there for 6 more years, and we grew tremendously during that time. So after 9 years of scraping by, and growing relatively slowly, we really accelerated the business and got it up to 250 people in 2016 when we sold that. So that was my sort of most of my career. That's a 16-year journey of entrepreneurship through different stages and raising money. We ended up acquiring 5 companies, did all kinds of things. When we were bought by Vista Equity Partners, which some of you who follow private equity would know, a really large firm, and they merged Gov Delivery with a smaller company called Granicus. That company still exists today. It was sold for $1.5 billion 5 years after we sold it. Which, you can either say I set them up for success or, once again, didn't have great timing. So from there, I started another company called Structural, but I also started investing in VC funds and in private companies, invested in about 20. And really got interested in what is the way to kind of best support upper Midwest entrepreneurs and what's the way to best sort of make money as a venture capitalist doing that. So we'll get a chance to talk about that in a second. But I ran one more company for 5 years called Structural, that one raised a lot of venture capital, over $10 million, and was basically a heavily data-driven sort of internal LinkedIn. Companies like United Health and Ernst & Young and Procter & Gamble use it to connect and organize their employees. All right, I'll try. Oh, I got it. So that was Structural. Raised $10 million, very different journey, pressure cooked. We had money from J.D. Vance, some of you may have heard of. He was one of our investors. He actually made the investment decision and then transitioned it to a different investor who was great to work with. Locally here, named Mary Grove, who was on our board. We had money from a lot of venture capitalists in town, from Steve Case, he was the one who worked with J.D. Vance. He's the former, founder of AOL, famous entrepreneur. And then we had money from the people who started the Salesforce Marketing Cloud in Indiana. They were my main partners. So very high end. I got to experience sort of really good venture capitalists and the challenges and opportunities that come with having $10 million when you have almost no revenue. It's very tempting to spend the money and whatever. So that was a very different experience. We were able to exit that business successfully, even though we had some ups and downs. And then joined Mairs and Power to kind of execute some of the ideas I had around investing back in companies like the ones I'd started. And Mairs and Power, if you haven't heard of it, has been around for 90 years. I kind of feel like it was started almost like horse and buggy era, age of wealth management. Mairs and Power was started in St. Paul, still in St. Paul today, as an early wealth manager and investment manager. And the company has grown as an investment manager, so think of it as, owning mutual funds and sort of picking stocks, not just kind of a Morgan Stanley wealth manager, but picking stocks that they think are going to be good, we think are going to be good, with a real focus on the upper Midwest. And we built up over that 90 plus years doing that in primarily public companies. A few years ago, Mairs and Power said a lot of the economy is not accessible to our investors anymore. because so few companies are public. So let's start investing in private companies. And they launched a fund, relatively small initial fund that made it possible to make those investments. Hired a longtime mentor and friend of mine and of Rick's named John Bergstrom. And as I sold structural, he asked me to join, and I've been working on it, like I said, for over a year. We've made a number of investments, and I've picked up working on some of the investments that John made earlier, like Akoya Go. We are a seed stage investor, but we have a very specific framework we do it with. We invest in technology and technology-enabled businesses that have initial traction of $500,000 to $1.5 million. These businesses are generally transforming markets and industries. So we'll talk about Akoya Go, but a couple other examples would be like Gem Health is a virtual sleep clinic. Pair Commerce tracks and enhances and tracks the efficacy of social media advertising for offline products like Cheerios. We have Better You, which is working on mental and digital health for people. So a lot of interesting companies, various types, but they're all tech and tech-enabled in some fashion. And then they have initial traction of $500,000 to $1.5 million of revenue. Typically, when we invest, and they've generally been fairly capital efficient. So they didn't. In fact, my company, Structural, would never have been something we invested in because we raised way too much money. So we like companies that are a little more efficient with their money, and that creates some optionality we like. And then finally, we like things that are at an inflection point, which we'll talk about because we're going to have a chance to talk about Akoya Go. And we have a team of 4. We look at 80 to 100 businesses per business we invest in. We've invested in 13 companies, 12, but the 13th one's been approved. 10 of them are in Minnesota, but we cover the entire upper Midwest and have drifted as far as Kansas City. So that's how we do it. I guess I'll add one more thing. When Mairs and Power invests, it invests in a stock. The stock is liquid. It's publicly traded. It's under all of the SEC disclosure rules. In venture capital investing, many of you would know this, but some will be less familiar. We invest, we're like getting into a marriage, first of all. These deals last a long, long time, 5 to 15 years we're usually expecting to be invested, number one. Number two, we are trying to help the companies. So, Rick does this across his entire portfolio, helping companies succeed at different levels. We are always trying to provide high impact support to the companies, and that's usually in the areas of talent, money, and growth. So that's how we get involved. Maybe I'll let you tee up Akoya Go.
Question though, and I don't know how much you're talking to people about the size of your fund and what the future looks like.
I am, because we manage $12 billion. I really can't get into too many specifics on that stuff.
Fair enough.
But yeah, I think you can always go to the website and learn more about what we can and can't do, and I'm happy to talk in more detail with people when I have the chance to read a disclosure statement.
Okay.
Nobody wants to hear a disclosure statement, do you?
No, we don't want to hear the disclosure statement. Absolutely not. So from your perspective, let's maybe start with Akoya Go. It was the first investment by Mairs and Power. From your perspective, based on talking to John Bergstrom, why do you think he invested in that company?
Well, I would say our criteria was not as established then. So, but I think John had a pretty tight philosophy on the types of investments he wanted to do, and it aligns with the criteria I just described. So, Akoya Go is software. It's generally would be called like vertical SaaS, vertical software as a service, meaning software targeted at a specific industry. And Akoya Go targets its software at supporting the management of private and community foundations. So a family foundation or a community foundation like the Minneapolis Foundation, the St. Paul Foundation. These foundations, like every business, they have their own nuances. They issue grants. They recruit money sometimes. If it's a community foundation, they might be managing donors. There's administrative process. There's rules, etc. I love businesses like that. And whether you're an electrical contractor or a bank or an insurance company, generally, just giving you the software that everyone uses is only going to be effective for certain things. So maybe everyone can use Salesforce, for their Salesforce. Everybody can use Windows, these business applications, letter writing, etc. But vertical SaaS targets the more unique business operations to that vertical market. And so we like that about Akoya Go. I know John likes vertical SaaS. I've invested in other vertical SaaS companies with him before Mairs and Power and as part of his team. The second thing was the momentum in the business. The business had some traction, some revenue, decent reputation with customers. The third is that due to an unfortunate event, there was a transition in leadership that led to the kinds of inflection points that investors really like. So particularly in venture capital investing, it's so high risk that you have to get very high returns. To get high returns, you need something that's growing at an incredible pace and never slows down. That's sort of the most obvious. Or you need to invest when something's growing okay, but you have a reason to believe it's going to grow better. And in Akoya Go's case, there was a change in leadership that brought in a leader John knew and I was very familiar with, John Long, who is a friend and collaborator of Rick's. And when John came in, John had successfully built a company called Aviante. He's a proven entrepreneur. People don't always love these analogies, but there's the argument of, do you invest in a horse or a jockey? John's like a classic jockey you would invest in. He knows what he's doing. He's made a lot of money for investors. He's great managing teams, etc. So that's sort of the first inflection point is John's come into the business. And the second inflection point is a business that had been a little sleepy. And Rick knows way more about it than I do, so it's kind of nerve-wracking.
This is a test.
Something.
I'm seeing how much he's been paying attention on the board meetings.
Okay. Please chime in anytime. But the software was being rebuilt and modernized to be more of a modern software as a service model versus more of a legacy model. And those two things, those two theories around the bet have paid off tremendously. It's a great company. It's done very well since we invested. Rick's done an amazing job with it. John Long is an incredible leader, and they have quite a strong remaining members of the team. And it's just the kind of investment you hope you make every time.
All right, so let's use that to jump into some of the other topics. Why don't we maybe try to, because any one of these we could spend a lot of time talking about, so why don't we just hit on them and I'll go through the list. Let's start with the jockey versus the horse. Like you said, John's a classic. Hey, we're betting on the jockey, but given the choice, would you pick one or the other?
Given the choice, if I had to choose, I would pick the jockey, for sure. But I would say that we do come in when we've been able to, when the business is a little more developed. And so we don't just invest off PowerPoint slides or short pitches or whatever. And so we do have a chance to see a little more of the horse, if that makes sense. And I, as an acquirer, by the way, I invested in the horse. When I owned a company and I bought companies to bring in, always the horse. Sometimes I got a great jockey out of it. They joined our team. They did great. But I assumed that I'm getting the horse and that's it. Because you often worry that when you buy a company, the entrepreneur leaves, and that's worth worrying about because they usually do. But as an investor, we're a minority investor. We have to be aligned with this person for a long time. We have to know that they're going to grind it out, that they're going to pivot, they're going to adjust, all of those things. So I would pick the jockey, but I do care about the business, and does the business have, I would say this, nothing makes me more concerned than when the business is not worthy of the founder. And I see it all the time. And I want to create a counseling service to be like, this business is not worth your time. I see it like daily, this problem. So I do care about both, but definitely pick the jockey.
Yeah, me too. They can get the most out of the horse, whatever that might be. So we heard a couple of pitches earlier today. What are some of the key elements of a good pitch from your perspective?
I think that the this is super easy to find online, and there's so many good pitches online and so many good resources. It's really easy to see what a good pitch is. First thing I'd say is I care more about the business than the pitch, and I'm pretty patient. So if I don't understand your pitch, I'll keep working at it. Not everybody will do that, but the elements of a pitch are pretty simple in my world. It's really why this. This is good way to pitch anything, actually. It works if you're trying to get your spouse to go out to dinner where you want sometimes. But it's basically why this? Why does this even make sense? Why us? Why this? Why now? Why us? What next? And if you get those things right, that's enough. The rest of the details is a Q&A process. It's not, but if I can't understand what I just described, I really wonder if you've thought about it, is the problem. I can get it out of you usually, but it's interesting how seldom somebody hits all those points, even though I think you're like one Google search away from getting that roadmap. It's not like I made it up. So those are the elements I would use. And an example would be, just to do one quickly, Structural, which was my second company. So why this? Employees are getting very disconnected in the workforce. It's making it hard to manage across locations, time zones, et cetera. And companies are suffering, employees are turning over. Why now? This is only getting worse. This was pre-pandemic, by the way. This was our pitch. This is only getting worse. More people want to work remotely, and more relationships between manager and employees are fragmented, and connections are breaking down with some really good examples. Why us? I felt this problem as a CEO running a 250-person company. We've already got traction in the marketplace. We've proven we understand how to solve this issue. And what next? If you invest in this company now, we've already built the product, we've got incredible revenue traction and pipeline, and we believe we can take the company to $5 million in the next 2 years before we need to raise more money. That's it. I raised $10 million doing that. It didn't hurt that I just made a bunch of people a lot of money with my previous business. That's a little bit of an advantage, but that was the pitch.
And I'd add trying to emotionally engage with whoever you're pitching. So trying to put a wrapper on it that people can understand and get connected with. So emotional engagement, I'd add to that. I mentioned earlier at the podium valuation. Valuation's important from my perspective in that it kind of establishes that you have a good sense of how you fit in the world. And so if you're grossly overvaluing your business, I think it paints an entrepreneur into a corner. What do you think of the valuation? When does it matter? And what happens if it's out of line?
I think that, you're really articulate and clear on this, and I think we agree that you don't need to talk about valuation at all unless somebody's interested in investing in your business and bought into the basic concept. So it's a little like salespeople in software will often go into a sales meeting and start answering questions about security, pricing, and procurement. But they haven't even convinced the person they're talking to that they want to buy the software or have any value, see any value in it. Well, it's the same when you're talking about pricing, which is what valuation is with an entrepreneur. If you think I want to talk about what percentage of the company I can get for $1 million first, and that you're somehow going to negotiate with me that way versus just convincing me that meeting with you again makes sense, you've got it backwards. Like, all you're trying to do when you're pitching an investor is say, I'm worth your time, I could fit with you, and this business concept has merit, value, and I'm the right person to execute it. If you get that right, the valuation can work out over time. The real challenge I think entrepreneurs run into later is, they think that somebody's gonna give us too low of a valuation or too high, and I will have wasted all this time. Well, still, the first meeting's not the right moment. You can start to qualify someone in the second meeting, the third meeting, what they might be willing to pay, how they'd think about it. But I don't think in most cases the entrepreneurs I'm working with even give me a valuation up front. They just pitch me, we talk about it, and then eventually I want to know what their expectations are, they want to know what mine are, and we start sort of working through things, and I think that works great. I'll just add that the biggest red flag, according to 3 of the best VCs I've interviewed, the biggest red flag for an entrepreneur is one who talks about control in the first meeting. When you take money from me, your job is officially now at risk if you underperform. I will try to get you fired. And that is very hard for people to say out loud in Minnesota. Like, we have all these people say like, founder first VC, or VC really likes entrepreneur. It doesn't mean I'm like not rooting for the person to succeed and helping them, but eventually if the person is literally failing, my priority would be the business being successful and our investment coming back. I don't own enough of the company to I'm not out firing people every day, but if somebody's really focused on control, that is a big red flag for me. And it doesn't mean they have a bad business. It means they probably don't just make sense for venture capital.
Let's talk a little bit more about attractive elements of a founder and a team. One of the things that comes to mind for me is grit, and it's not necessarily an easy word to look at from a quantitative perspective, but I'm kind of assessing them for basically how tough I think they are, and then can they accomplish a lot with never having enough people, never having enough resources, never having enough time. Those are just some of the things that I think about when I'm looking at a founder and team. How do you assess founders and teams and trying to figure out, hey, I find this group attractive or more attractive than another group?
Well, what you just mentioned is great. If you can figure out how to assess grit in an employee or an entrepreneur or anything, and if you can cultivate it in your kids, grit is the most powerful skill, I think, in this world. But I guess I would say, and I would add, I look at a couple things. One is I prefer people in the B2B markets, which we're often in. I prefer people who understand how to deliver a solution to a market than to entrepreneurs who have been the market. And the easiest way to explain this is, would you rather, if somebody came to you and had an idea for a new candy bar company, would you rather hire somebody from Hershey's or somebody who loved candy bars? Just think about that. But yet, many B2B investors get intrigued, unfortunately, by I had a horrible experience with, and there'd be emotional stories. I had a horrible experience with, my mom died of breast cancer. And it made me want to solve breast cancer, this issue, the diagnosis of it, everything else. And so I built this company. Meanwhile, somebody who's competing, because most of these ideas have competition, has been delivering solutions to help address breast cancer diagnosis for years and now has a new idea in it. Mm-hmm. Who would you hire? Who would you invest in? So that is a really big one for me. And then the other, in the way I look at assessing grit, is just velocity. Do you have velocity? And the opposite of velocity is distraction. So if somebody talks to me about things they control instead of things that they've made happen by influencing others, it can be a bad sign. So what have you accomplished this week? I hired a lawyer, I rented some space, I hired a member of my team, I wrote a blog post. Well, I could have done all those things. What did you accomplish? Did you sell something? Did you get somebody to use something? Did you get somebody to join your company for 25% less salary than they were making somewhere else? It's like you just are looking for those types of things. And that's how I try to assess people along the way.
We touched on a little bit the team and some of these characteristics of the founder and the team. Given that you started and ran 2 businesses yourself, what were some of the things that went through your mind as you were trying to build a high-quality team? And when you're looking at making an investment, how do you assess their ability on building said team?
I really prefer and gravitate more towards people who don't want to outsource selling early. So even people who build products, if the first thing they want to do is hire a salesperson to sell the product, as opposed to sell it themselves, that can be really concerning. So that's my first assessment I'm making is the person I'm talking to capable of selling this product? Have they proven it? If they haven't, they got to be really good at hiring salespeople because it's hard to do, right? Especially early if the founder can't sell effectively. For me, I mentioned what I like about the founder. Seeing a founder who understands and has self-awareness about their own weaknesses and the opportunities and is able to recruit other really talented people and has a sense of followership, is always a good sign. So I love when somebody's like, I'm doing this. This is one of our investments very specifically. So it's a real example. This guy comes out of a major company. He starts a company. He goes and hires somebody in product from his previous company. When I ask a colleague, former colleague, about him, she says, he's great. And he knows what he's good and bad at. And she says, let me give you an example. He was able to recruit the best product manager from our company to join him. And I was like, boom, I'm interested. I mean, that is like the greatest example. That company has been the fastest growing company we've invested in. And it's because this guy is amazing at knowing what he's good at and focusing on it, knowing what he's not good at, and hiring other people to do it. So I love it.
Yeah, I can't say that I've had a lot of positive experiences with the entrepreneurs who maybe aren't quite as self-aware and are less coachable. Critical feature to success, absolutely.
It's like I don't know if I've never talked to you about this. I've been thinking about it a lot lately because I have, very big range of entrepreneurs, but in general, our entrepreneurs are either big company people who've proven they can do startups or startup people who've either had some success and want more or have just kind of ground it out and this is the business where they finally figured out how to make it work. Those are the two basic categories. Somebody from Optum or Piper Sandler or whatever, and they made it as an entrepreneur, which many of them don't. Most of them wash out pretty quick and go back to the home base, or the other group. There are some coachable entrepreneurs, and there's like a fine line, because when somebody gets so coachable as to not have their own opinion, it's even worse, and it's hard to figure out if somebody's like coachable or indecisive sometimes. And I don't know, I should probably pick Rick's brain about this because you have a lot more experience assessing that than I do, but it's been haunting me lately because I have one particular entrepreneur who I feel like asks 30 people for advice before he ties his shoes, and I'm trying to help him through it.
Yeah, not an easy one, that's for sure. How about product and technology forward versus marketing forward? I know that I like and have picked some companies that I felt like the product was either good or aiming to being good, technology was interesting, and I worked with them to help with the distribution, marketing, etc. With that said, sometimes the tech people can totally be dismissive of marketing and sales, saying, oh, I'm going to build the best mousetrap, and therefore people are going to come flocking to me. How do you assess that product technology versus marketing dynamic?
This is tricky for me because I am really a marketing sales-oriented person. So I've worked with great technologists. I've had the opportunity to lead companies that had incredible technology. In one case, my first company, I was director of marketing of a company that had incredible technology, and what a blessing it is to be able to do that. I think that the two things have to be in balance, and sometimes one's better than the other. But somebody who's just really, really good at selling but has a really weak product won't be able to overcome it unless they have a strategy to do so. But I would say more often, somebody with a great product who has no sense of how to move it into the market is the most common failure in any business.
Okay. One of the things that I look for is, I call it a priceless advantage, meaning you get in a deal, and if somebody threw $20 million at that problem and told somebody to go, hey, let's go compete with this business, but you get a team that has so much experience in a domain, or they've spent a lot of time in the market and just run out ahead. How do you assess this kind of priceless advantage, which I think is important?
Priceless.
I call it priceless. You can't throw money at the problem. Like Centera, the drone imagery analytics business, this was 2015 when I got involved. Their 10, 11 person engineering team had 14 years of experience back in 2015. And you couldn't just throw money at a problem. We talked about Akoya Go. The founder started that business in the late 70s, so they had decades of institutional knowledge baked into the product, almost like kind of the moat kind of thing. How do you assess that? How important is it to you? To me, I think it's important.
Yeah, I mean, I really have been focused for the last many years on how differentiated are you if coding goes to infinitely free. How advantaged are you? So we're doing software. What if features are free? What do you have? And so Akoya Go has that knowledge. They have a loyal customer base. They have the learnings from that. There's a lot of opportunities to capitalize even more on that at that company, which I'm excited about. I went to their user group, and people are, treating the product leader like he's a rock star. And I was like, whoa, that's a lot of excitement over software. It's great. Couple I like that are sort of, priceless advantages that are built into the company and the business model more so than like what your example was. But I like marketplaces, marketplace effects, network effects, and sometimes data effects. I'm getting more nervous about data effects because AI is making even small amounts of data too useful. Marketplace effect, we have a company, Halo, we're invested in Chicago. Cargill pays a monthly fee to use Halo, and Cargill gets great software for posting research projects it wants done by university professors and college professors. When it gets posted on Halo, Halo has the marketplace of college professors who will bid on it. So they're getting a subscription fee, but they're offering a marketplace. Nobody can replace that marketplace. You and I could build a new version of LinkedIn tomorrow. It's not going to be worth anything. It's just a post your resume online service because nobody can connect through it. So that's a network effect, different kind of sort of similar to the marketplace. eBay is a good example of marketplace effect. There's all kinds of things. So I think of things like that a lot, probably more so than maybe the way you've exactly framed priceless advantage. But and then I have really been thinking about differentiation. And if you as a company, if all of your ideas are, I'm going to do these things that every other company does, the only way to compete the other companies is money. And it's scary when you meet someone and they're like, I need to generate users for my product. And the way I'm going to do it is the Microsoft marketing plan. And I'm like, oh, how do you think you're going to do versus Microsoft with that plan? Because they have infinite money and you have very little. Now you meet somebody who's like, they get all excited. When we go to trade shows, we don't put up a booth. We had our co-founder dress in a costume and he sat outside the thing and he handed out these and we gave away 10 iPads and we did this and then people logged in and that got demos. And when we get a demo, we have a close rate of 50%. I'm like, sign me up for that guy, not the person who just wrote a $25,000 check to the trade show like everybody else and showed up with a smaller booth than their larger competitors. So that's the other form of advantage, is almost an execution. Do you execute like the pack, or do you execute like you have, some unique point of view or courage?
All right, let's do a couple quick questions. If we have any, right here in front. I'll get you next.
Yeah, I love the idea. I got a lot of voice, so I'm doing the microphone. I really love this idea of if features are free, what else do you have? Can you give us a couple more, like companies like, this is what I mean by that? Just dig into that a little bit more. That's super intriguing.
Well, my first company, which I sort of talked about the growth trajectory, but one of the things that influenced the growth trajectory, there were two main things. One is we realized it was just as hard to sell the city of South St. Paul as it was to sell the IRS. And then we're like, maybe we should sell the IRS. So it wasn't about getting faster, it was about going bigger. But it was an intuitive observation that took way too long. I'd be much faster at seeing that today. But also I had to be young to execute it because it still took a hell of a long time. And then the second thing was building network effects into the product. So fundamentally, Gov Delivery at a really basic level was like email marketing for government or email communication for government. Well, at the same time, Exact Target, Marketo, Constant Contact, MailChimp, there's all kinds of other services that do it. People would be like, how's Gov Delivery so successful? Well, my partner came up with this genius idea of automating the alerts. So if government kept its website up to date, the messages went out automatically. Nobody had to come in and type them and send them. That was amazing. That won us a lot of customers. Then I'm very competitive with them, so I'll just say I came up with what was really the better idea a few years later, which took forever to execute, which was if you're signing up for snow emergency alerts from St. Paul, let's get you signed up for snow emergency alerts from Minneapolis at the same time. We have both as customers. If you're signing up for the IRS, let's get you signed, and you're sitting in St. Paul, let's use geo location in the browser to promote St. Paul to you. Now, any government who buys our service is going to get way more people signed up than if they just set up their own MailChimp or whatever. So the first example is an example of a very specific feature that worked for our market that Walmart would have never used. And the second example is leveraging the fact that we earned our way to some kind of market dominance and then accelerated it by making the product more valuable for the second customer than the first and more valuable for the 1,000th customer than the 100th, if you get it. That's literally a natural, that's the definition of natural monopoly in economics, roughly, and I think it's great.
Over here.
Yeah, I just want to ask you, if you have a technology that says way outside the box, okay, do you guys have like people that do assessments on science or type of things to get funding for that? I mean, that seems like it's hard to find funding for a new technology that's not being implemented today to help people to understand it.
Well, there's a lot of flavors of venture capitalists out there, and so usually in something like that, you want to get to the venture capitalists that understand your market. So there's an amazing one in town called Gravity. It does not usually invest in this market, but they're located here. They invest in, cyber currency, blockchain, NFTs, and other sort of major innovations. Deepwater, many of you would have heard of like Gene Munster's, somewhat similar. So they're going to be making bigger bets on breakthrough innovations, and you would go to them with your idea if it was in a space they knew, and then they would be the experts. We tend to rely on traction to mitigate our lack of specific domain knowledge, which means that if you have something that's in the incubation phases, we're not the right investor. But in general, I think you want to find an investor who would have a predisposition to your space or has demonstrated the patience to go hire the outside expert or whatever. And like when I was raising money for a government tech business, it took me a while to learn this, but if I was meeting with somebody who'd never invested in a business that sold to government, I didn't know it, but I was wasting my time. Joel.
Workaholism used to be a badge of courage in the business world, and I think that's being questioned. Do you have any comment on business leaders role modeling healthy, balanced lives and has structural work in that domain, and is it spreading a different model?
I hate talking about this because I don't think I'm in the mainstream on it, unfortunately, the new mainstream. I would say I got asked what my work hacks were recently, and I was like, work twice as hard as other people. It's guaranteed. You'll get something close to 70% more done, because you do fade a little bit. I think that personally, and I just had a big conversation about this with venture capitalists in Indianapolis who are really successful at it. I think work-life balance is one of the worst phrases ever used. If you set your work up competing against your life, you are never going to win and be happy. it has to be integrated. There's different ways to do that. It doesn't mean being always on. It means just figuring stuff out. And, for God's sakes, don't raise venture capital. We're going to bust our asses for you. And if we see signs that you're not doing the same thing, it's just a really bad fit. We should have not invested in the first place, whatever. That doesn't mean missing baseball games or being a bad parent or any of that stuff. It just means you have to figure out how to be all in. Maybe the Monday night football party you like to go to every week needs to go. You need to drop your season tickets, whatever. And you know what? Your business has to fill enough space of happiness in your life that I am not asking anything of you to do what I just said. And if you have a cap on the hours you work per week or whatever, entrepreneurship's just really not for you. It's like 8 or 9 billion people on Earth. I mean, do you really think you're going to outcompete them in 35 hours a week? It's just an insane idea that we've introduced to young people that is the way to change and impact the world the way you want. So that's please tweet this out and get me canceled.
All right, a couple of things. We are at 1. I'm going to answer this question, and then I want to do a couple of really quick ones. So if you can bear with us for a couple more minutes, if you need to go. But if you're willing to hang out, let's just try to get a couple more minutes. Yes.
Real quickly, you talked about funding for companies that are either getting established or they're trying to get established. Do you find yourself, once a company they've got operational, sales efficiency, repeatable, they're really a solid business, but they want to be able to expand maybe with mergers and acquisitions or franchising or growing organically, and they just need more capital. Do you find yourself investing in that, or do you kind of direct them more to banking options? We're past the point of having a proof of concept. We got a repeatable system going. We got leadership in place.
I would say our companies can be at various stages on that trajectory, but I mean, I mentioned $500,000 to $1.5 million of revenue is our target. We've been coming in entering most businesses probably because of the market, closer to $1.2 million in revenue. If a business can have that much revenue and be pretty proven on the things you said, it won't be scalable and everything, but we'll talk to anyone that's in our range, regardless of where they're at in their maturity. And in general, what you described as private equity or bank financing probably is the better solution.
And then I would add, with all due respect to the venture capitalists who aren't sitting on this stage, it's a mercenary business. If you show somebody an opportunity to earn a return that risk adjusted is fair and attractive, then you're going to find an investor. Because really what Scott mentioned, they look at 80 to 100 deals to pick one. I probably don't do that much, but I do a bunch. And you're really looking at like, hey, what are my probabilities of winning, and how big is that upside? So at a minimum, if you're going to call a venture capitalist, you better be thinking 5 times in 5 years. We heard that sometimes it takes longer, but 5 times in 5 years is a 38% IRR. If you show somebody like Scott or me something that earns 10%, it doesn't fit the risk profile that we're looking for. And if you want a banker, we got one right over here that has sponsored this for a long, long time. All right, I'm trying to hit a deadline that we've already gone over. So Scott, give me like 1 or 2 words. I'm really gonna push on here. Our lightning round, 1 or 2 words to answer a couple questions, and then we'll be done. What's one thing that you want the audience to take with them today?
Use the resources on the internet. Too many people don't. It's amazing.
Okay. We heard some pitches earlier today. What's kind of the first thing you zero in on when you hear a pitch for the first time?
Can I explain it to my mom?
Okay. How about the most common mistake that you see business leaders make?
Hiring for experience and paying too much rather than hiring for trajectory.
How about a pet peeve that sours you either on a pitch or an investment after you've made it?
Any lack of transparency of any kind.
And the last thing, any advice that you were given in your career that you wish you would have gotten earlier?
Build a pipeline of talented people that you want to work with. Constantly build it. Invest real time. I wish I'd heard that earlier.
Okay. All right, great. Thank you all for being here. Again, you need a sticker and the ticket to get out. Our next session is November 7th. Again, doing it in partnership with the Private Directors Association, and we're going to be talking about designing and launching boards. Thank you very much.